I do want to kick it off with you, though, Mike. We've had a few hours for the dust to settle. Is this a report that was weaker? Like, what's the assessment here?
I think the bottom line, to just skip to the end of the book, is that the labor market is weaker than it had appeared, but it's not weak. It's not a problem for the Fed to have to deal with. And there were, as you mentioned, some quirks in the data this time. And everything Kevin said was true about with the labor force declining. You need fewer jobs to employ people so the unemployment rate can go down. And that is something that the Fed's going to have to think about in terms of what is the level of interest rates that keeps the unemployment rate steady.
We'll dig into all of this and more in just a minute. First, I want to bring in Matt Luzzetti, chief economist over at Deutsche Bank. Do you agree with Mike's assessment here that, yeah, on the surface it looks weaker, but it's not as bad as sort of the headline number?
Yeah, I think absolutely. You got a downside surprise on payrolls. You had the 100,000 of downward revisions to prior months. But I think what it does is it confirms that break-even number is just lower. So there's various Fed estimates out there suggesting that the break-even number could be as low as 0 per month. Mm-hmm. Over the past 3 or 6 months, we're running at 20 to 45,000 on headline payroll numbers. With that backdrop, we've seen the unemployment rate decline to the lowest level in 18 months. We've seen other measures of labor market slack actually tighten on the margins as well. And so I think it actually fits more with a story where the break-even number is quite low. We see payroll gains trending kind of around those levels, maybe a little bit above. Labor market slack tightening at the margins, but it takes away some of the upside risks to the labor market that the Fed might have been contemplating.
All right. So when it comes to, we've got actually a question I want to bring in from a viewer and listener. It's Mark in Toronto, and he says, what impact do boomers retiring have on the labor participation rate and unemployment make? And if we could address that. I have to say, I have some boomers in my family who've retired recently or in the last few years, and they have at least 3 or 4 of them that have left the labor market. Matt, is that something that is certainly at play here?
Absolutely. So if you look at the labor force participation over recent months, in June, there was a big decline in prime age, which I think you alluded to, and specifically the 25 to 34 age group. That partially reversed. I think the bigger structural trend is labor force participation from 55 plus continues to collapse. There's a question about whether or not that's worrying or not. I would actually argue that it's really in line with what you would expect from demographics. So if you look at different age groups with 55 plus, their participation rates are actually not moving around all that much. So what's happening is people are just aging into buckets where they work a lot less, where their participation rates are much lower. And we're in fact much closer to what I would expect from a demographics implied trend from the labor market.
Well, Mike, what about the other end of the demographic spectrum? And that would traditionally be new entrants to this country entering the labor force and younger immigrants. We've seen that dry up significantly over the past few months. And it's certainly by design with this administration. You addressed that with Kevin Hassett a little bit in one of the questions that he answered. Does that work in our economy when we're not having enough kids?
It isn't good news for the overall economy, as we were talking about with Kevin Hassett. The size of the labor force is one input into what potential growth is. And if the labor force isn't growing, you've got to get more out of productivity. Kevin and Warsh thinks you will eventually, not yet. So it is a problem for the economy overall. And you can see that in the overall participation numbers as well, although prime age has ticked up a little bit. Things have loosened up a little bit compared to where they were. But the demographics at the other end, as Matt was saying, that's been going on for quite a while as baby boomers from 1946 started retiring. And now we're past the peak of baby boomers being 65. So that'll be less and less of an issue going forward, but it still takes a lot of people out of the labor force.
Is it too soon? Well, I feel like there's a million things I want to talk about because demographics is things, I know we've talked with you about it, but I do think about longer term, if we don't allow immigration into the country and we have an older workforce, how much the economy here in the U.S. is at risk in terms of growth. Matt, is that something you guys are thinking about a lot or studying?
Sure. I mean, I think if you look at projections for population growth and the size of the U.S. population, as you look out 5 or 10 years, without positive net immigration flows, you have a declining labor force, you have a declining population. The U.S. is not the only economy, global economy, that is dealing with these issues.
We've seen this movie, right?
Correct. We see these issues in various parts of Asia, Europe. Many of these economies are actually worse placed than the U.S. is from that perspective. But no doubt, we rely on positive net immigration flows as we look ahead. I think, as Mike mentioned, the hope is that productivity growth can pick up. It has been pretty robust over these past 2 to 3 years, and that can be the supporting mechanism for overall growth. So far, it's working out okay.
Yeah.
But it's a bigger question as you look ahead.
Okay, I promise we. Oh, go ahead, Mike.
I was just going to add on to this. There is one aspect of this that the productivity can't really solve, and that is the fewer people that are working, the lower the dependency ratio is, and so Social Security gets less funding, Medicare gets less funding,
tax
and
base, right?
That is an ongoing issue, and nobody has any idea when Congress is going to address this.
I keep saying if robots are going to replace us or AI makes us more productive, but robots don't buy lunch, or robots don't need their shoes shined, or robots don't need to go shopping for shoes. I'm just. They
need to be oiled, though. I think
it depends.
And maybe rebooted sometimes.
It depends. Mike, I want to get to the conversation with Kevin Hassett this morning. At one point, talking about hourly earnings, and he then brought up weekly earnings. You said something like, I don't know if the president's watching, the Oval Office saying, you got your point, though, and Kevin, good job. And Kevin said, I don't know if he's watching, but I'll find out. And I want to get both of your perspectives, but Mike, speaks to the president, who watches a lot of TV. We know that, and responds. Is that typical of a president? Is it shows his involvement in what the message is that's getting out?
I think it's just unique to this president that he likes to do that, and he likes to hear people talking about him. And he spends a lot, from all the reports we get from the White House, he spends a lot of time watching television and watching the various news programs. I don't know that he was watching Kevin Hassett today.
But putting pressure on then his members of his team when they're on air.
Well, yes, but every White House does that in the sense that you're sending out a spokesman for the White House, so that person is not going to say, yeah, we blew it, this was a bad policy, or something like that. They're always going to try to present the best numbers. And I was thinking when Kevin and I were having that conversation, the old saying about you can torture the statistics any way you want to get the numbers that you want.
Right.
The bottom line to the White House, though, is that average hourly earnings are falling behind inflation. And whether you use one measure or another doesn't really matter, because the public thinks that's happening, and that's their political problem.
Well, speaking of communications, you and Danny Berger asked Kevin Hassett about the communications between the president and Kevin Warsh. Let's listen to what he had to say.
There have been some news stories that the president's talking to Kevin Warsh, and of course he is, and he talked to Jay Powell too. But the other thing is that Kevin Warsh and the president have a very close long-term relationship, from New York City, from Florida, and they talk about the economy all the time. It's very, very natural for the president to do something like say, hey, Chairman Warsh, what do you think about today's job number? And that's a very normal thing for him to do. But I think that's the way you should think about the bounds of the conversations.
Earlier on Bloomberg TV with Danny Berger and Mike McKee. Matt, I want to toss this over to you, because Kevin Hassett also said that the president respects the independence of the Federal Reserve. And I'm curious, based on the reporting that we've seen around the conversations happening between the Fed chair and the president, and what the president has said publicly and on social media throughout this term and his previous term, is the view now, is the market viewing that the president respects the independence of the Fed?
Look, I think we don't really know the context of the conversations that are happening. It seems like it might be more frequent than what has the interactions between the president and the Fed chair than in the past. If you look at market measures, I think what we like to look at are inflation expectations showing anything that is worrying. Are they suggesting that the Fed's credibility is at risk? I think last week you did see a notable rise in inflation expectations. I don't know that that was anything kind of tied to the president, but I think it was tied to Chair Warsh's specific comments around willingness to potentially raise rates, unwillingness to say that they were targeting 2% PCE price inflation, and just the overall conversation, I think, and the language that he used, I think raised some risks from a market perspective about whether or not the Fed would do what's necessary to keep inflation in check.
President Trump did an interview with Punchbowl today, and he reiterated his preference for lower interest rates, but acknowledged it is not the central bank chief's decision alone. So kind of making or taking a little bit of a softer tone in some of the criticism. I mean, when it comes down to it, I know we are already thinking, okay, what does the Fed do next? We've got inflation prints to get through, right, Mike? We've got more economic data. Who knows where the Fed will be, and Kevin Warsh and everybody on the FOMC at the next meeting?
Well, clearly you don't trade Fed funds futures. You're right. We don't know. But the people who do trade these things have to decide on a minute-to-minute basis what they're going to do. And they have backed off the idea of a September rate hike. But the important thing is we're going to have two more inflation reports,
Right.
one more after this jobs report. And so there's going to be a lot of data for them to hang a decision on. We don't know what that data is going to say. And so at this point, it's too early to speculate. I mean, it's been going into this, everybody was saying, well, if we get a bad number, then the Fed might have to back off. And we got a bad number, so they're saying the Fed's going to back off. Now we're all on to, well, let's see what we get on Wednesday with CPI, and we'll make a decision.
It's our favorite part of the day.
Well, Matt, what should, the Fed has a dual mandate, and I think for a lot of people the last few months have said, okay, the labor market is strong, so
Yep.
the focus should be on getting inflation down. After today's print, does that view change? Should the Fed still be squarely focused on that part of the dual mandate?
I don't think it changes. Clearly you had a downside surprise in payrolls, but if you think the break-even number is close to zero, you're actually running at or near those levels. The unemployment rate's at 4.1%. It is well below what the Fed thought it was going to be at the end of this year. It remains our best measure of labor market slack. I think you have a shift of risk distribution on the labor market. Now there's not as much upside risk, but September will be about the inflation data that we get over the next 2 months, especially if you get a bounce back in payrolls next month.
I mean, inflation's still a problem, right?
So in our view, it is. I mean, if you look at PCE inflation, which is what the Fed targets, it is the highest that it's been since 1992 if you strip out COVID. We agree with an evolving Fed assessment from many officials that it is more broad-based, it is more demand-driven, AI-related investment is a source of inflationary pressures, underlying inflation is stuck closer to 3%. None of that changed today. We'll get an update on that next week from the CPI.
Okay, I want to just throw this last one at you, even though we don't have enough time, Mike. Lisa Cook, because in the conversation about independence of the Fed, since we heard from Kevin Hassett this morning, our Bloomberg News team reporting that President Trump has revived his threat to fire Federal Reserve Governor Lisa Cook over those unproven allegations. Update us here on this.
Well, they apparently sent Lisa Cook a letter that said the president is considering firing you because of the allegations of mortgage fraud, and you have 3 weeks to respond to this letter. Remember, the Supreme Court said that the president couldn't fire her, but because she didn't get due process. They didn't decide the legality of her particular case. And so now the White House is coming back and trying to follow the dictate of the court and give her the opportunity to respond. And we don't know how this will all play out, because even if she's found not guilty, the president could come back and say, well, yeah, but she was implicated or something. So this is just it's Friday, put it that way. And this is the kind of thing you get on Fridays.